Hey everybody, thanks for coming to today's training to be able to go over strategies to beat the competition and submit bulletproof buyers in any market. We're going to be covering quite a bit today. The whole entire point is just to make sure that we can position you as the agent in a place where you know that the buyers that you're taking out there are in the perfect position to go out and purchase a property. And if it's not the right time, that we position them for when is the right time so we know when to be able to follow up. But in today's potential market where, buyers' commissions might need to be paid from the actual people purchasing the property, it's more important than ever to make sure that you're not wasting your time and that we're also in this market positioning the buyers to be confident that it is the right time for them to go out there in today's market and still buy a house, given that we're still in a higher rate environment, even with the Feds potentially lowering rates, over the next upcoming meetings. But we all know that buyers are tired, agents are tired. There's endless searching and multiple offers. It's creating heartbreak for everyone. You're out there putting in offers with limited amount of properties, so there's more competition than ever, even with the higher rates in a lot of markets. And so clients are frustrated and they're looking for answers and results, and not being able to provide them has left us feeling helpless and powerless. So what I want to do is, until now, we have a strategy where we're in the same routine, that we switch everything up so we're not following the same routine, hoping that we get yesterday's results in a market that has changed. And we all know that buyers are scared of a market that feels like it's moving too fast. They feel we're pushing them out of their comfort zone. They want to wait for rates to drop because that's what they're hearing in the news. What we need to do is we need to provide them the data to be empowered to make their own decisions and not rely on emotions, opinions, and conjecture. They need to be prepared with a plan when if the appraisal comes in low. They need to be able to compete with all cash offers. And you, as the real estate agent, shouldn't be the one doing all of the work. Okay, so what is the solution to this? Well, what we like to call it is bulletproofing your buyer. And what I do on my end with every client that I speak with is, first of all, a comprehensive market analysis. They need to have a much better understanding of the housing market. And when they know that, then they know why. So each housing market's going to have its own little intricacies, right? So we need to be able to present them the data for their market. They're watching perhaps national news telling them, that home prices are going to fall, or they keep going up, or whatever it is. We need to show them the true numbers for where they want to move and where they're currently renting. We need to address the psychology the psychology of the buyer situation. A lot of clients that I speak with, they know that they can buy a property because we've given them, or a lender's given them, a pre-approval letter, but they often don't know why they should buy. And so we just need to present that to them, but maybe it's not the right time to buy. It doesn't really matter to me at the end of the day. Obviously, in certain markets and certain people's financial situations, I truly do believe they should buy, so I'm going to push them a little bit more. But if they're financially not in a position, or they're planning to move in 2 years to somewhere else, or a life event's really going to change for something, maybe it is better for them to wait. But we don't know until we start talking to them about their personal economy, what they're currently doing, where they see themselves in 3, 5, 7 years. So that's what we need to do, is really sit down with them and go through their individual situation. And that's what I do to be able to help you be able to get that information, one, and then provide them with the data. So when I hand them back off to you, they're ready to go out there. We've already overcome a lot of the objections and fears, and it's not just coming from you. And lastly, appraisal gap strategies. And this isn't just an appraisal gap strategy, but it's just solutions for everything, right? We can't always fix all the problems when we're out there looking at homes, but there's usually solutions that we can come up with if we're in this every day and we're being strategic and trying to figure out ways to be able to overcome things that do come up during a transaction. So, first of all, being prepared. So, knowing how to approach a low appraisal from the onset so that you can waive appraisal contingencies if it's something that needs to happen in the market that you're in or for the property that you are looking at. If your buyers, it's a 10 out of 10 for them, they really want that home. And we want to make sure that these borrowers for sure can qualify for what they're out there looking at. And so we can do a fully underwritten approval. That way, if you want, again, if it's a 10 out of 10, they can do this with no loan contingencies. We can put an offer in that competes with all cash offers. Okay. Knowing how to approach everything from the front. And then also, we do credit coaching, which is just a full review of the credit report with strategies for them to be able to increase their score quickly, which can increase their buying power or at least make them more comfortable with the rate and payment for the type of home that they want to purchase. So let's talk about the comprehensive upfront market analysis. Okay. Again, your clients, we want them to be prepared for the market that they're going into based on their particular situation. So we're going to look at the year-over-year change in housing inventory. If we're looking at all of U.S. housing, we all know that the hole still hasn't been filled. We know that builders stopped after the crash and that we've been behind building inventory for many years over and over again, and we're still millions behind. Now, some markets are doing better than others with catching up with housing needs, but other markets, like I'm in San Diego, there's really no new place to build unless you just keep moving further and further out. You're not going to be able to build in the city. So the pricing changes aren't going to go down. They're going to continuously go up. This is something that, you just know and you might tell them, but we need to show them so that they can see with their own eyes, because a lot of times you as the real estate agent, the person that's going out there to purchase a property, depending on how much they know you or trust you, they might think that you're just trying to sell them, because at the end of the day, you only make money if they buy a home, right? So you're obviously going to tell them that right now is the best time to buy. You're obviously going to do all of these things in their mind. So we got to be able to not just tell them, but show them. And so we can also show them the number of single family homes and housing units completed. All right. So we can see that the average annual units completed for 13 straight years, it would be below the 50-year average. Okay. So, right before the crash, there was 4 consecutive years of record-setting numbers. And then after that, we've been below that line now for a considerable amount of time. And it's not that easy just to catch up. And supply of homes for sales nationally are down 71% since 2007. Now, when I'm talking to borrowers, I might use some national numbers or local. It just really depends on each individual person, and if they know which market that they're going to be in, we'll try to get those numbers put together. But even the national numbers really drive home the point that in most markets, we're behind and housing prices are not dropping. Okay, and months inventory of existing sales for single family homes is still very far behind. Okay, we're starting to catch up. This graph is a little bit older, but we're still very far from where we need to be. And so what does that mean? Well, it just means with lack of inventory, right now there's not a ton of buyers out there because rates are higher. So you can still potentially, on certain homes, get seller credits, go under asking, or at least not have to write off all your loan contingencies and all those things that were going crazy during the pandemic. But we know that's coming. With rates dropping, more people are going to jump back into the market, which is only going to create more competition. And so here's really the underlying problem that we need to show them. It's not just the fact that we have less homes on the market, but there's more people that are at the age of purchasing homes for first-time home buyers. Why? Because of the baby boomers. Okay, so there was the spike. Right now those people are in that window of purchasing homes, and there's more of them. And then beyond that, we have the people that are baby boomers that are locked into lower rates. They're living longer. They're able to take care of themselves longer because in a lot of cases they're healthier. So they don't have to move away. They don't have to potentially downsize because they can take care of the home that they're in right now, or they don't have to move into a care facility. And so if people really want to wait this out, what they're doing is they're betting against the US housing market. And long term, that is a bad strategy. If you look from 1942 to 2023, the actual market has only gone down 6 times. It's been flat 5 times, and it's gone up 71 times. Okay, so when did it go down? Well, we can see 7, 8, 09, 2010, 2011. When was that? Well, that was right after the crash. Okay, but what did the crash happen? Well, we were loaning money to people that were unqualified, and that's what caused that whole entire problem. But if you look at this historic data for mortgage credit availability index, okay, this is basically telling you how much risk we have. Well, during the crash, there was a ton of risk out there. Okay, now there's much less loans that are risky. Yeah, we have some home equity lines of credit that allow people to go up to 90%. We now have some down payment assistance programs again that is allowing people to put zero down, but there's not a ton of that, and they're still qualifying based on their income. Okay, it's not like there's these no income doc loans. The only thing close to that is an investor style loan, but they have to put 20% down. So there's really no risk to the lender in those situations because they won't do that in certain markets. So after we kind of provide the data, we also need to address the psychology of the buyer situation. Again, they know that they can buy, or if they can't right now, we'll explain when they might be able to based on their income and debt to income ratios. But let's just say that they are pre-approved for a certain amount, but should they? And that comes down to each individual's risk tolerance, where they're going to be 3, 5, 7 years from now. Do they plan to rent in the same place? How's their lifestyle going to change over that time? How's their family unit going to change over that time? So our job as a lender is not to pre-approve a client and close the loan. My job, I believe, is to help remove the fear and the uncertainty and replace it with education, confidence, and motivation. So when they are looking at properties with you, you know that they are ready to potentially pull the trigger if they find the right property. And we got to make sure that we're not letting our buyers compare apples to oranges. Okay, so when I talk to somebody, I'm going to ask them, hey, what's your current rent? If they're not going to buy a home or they don't buy a home, are they going to be able to stay in their current rental for the next 5 years? Okay, what would they pay if they did move to a new rental, or what is the rent increases each year? And if they potentially have to move, maybe they're in a 2-bedroom, they're going to need to move to a 3-bedroom or something like that. What is the cost of moving? So we can look that up for each area and where they're at and what they're currently paying. But at an average at 5% rental increase each year based on $2,500 rent, the payment in 5 years is going to be $3,750. And during that 5-year period, they're going to pay an average of $3,375 per month. So with the tool that we have through MBS Highway, we can do a buy versus rent comparison so that it can clearly illustrate the benefits of home ownership over renting to our clients. And this can really be the crucial difference in their decision to move forward with a home purchase. Like I talked about before, seeing is believing. So when we're telling them is one thing, but when we actually show them the numbers, it's totally different, especially when the numbers match what they're currently doing today. So besides the rent versus buy analysis, we can also do a personalized cost of waiting analysis. So we can do it today, 6 months, a year, 2 years. This program will allow us to change the timing of it, what the market is for specifically for them, so that they can see the numbers and truly be able to weigh the options and make a decision based on facts and figures, and not based on what their parents are telling them, their friends, what they're reading in the news or on social media. And lastly, when rates do fall, or if you're in a competitive market, we may have to bid over the asking price. And so we can do a bid over asking analysis with this tool as well. And this is to help clients that may be reluctant to increase their bid. It'll give them clarity that they need to understand exactly when property appreciation is going to cover the additional bid over asking that they're willing to go up to. Now, anytime that you're going to bid over asking, there's always the chance that the appraisal comes in low. So we need to have an approach to a low appraisal from the onset, especially if you're going to waive any appraisal contingencies. This is really becoming hard in industries in certain markets because at the speed of which things are appreciating, there's not a lot of data to support the price in some cases. Appreciation is just happening too fast to rely on some historical data for some markets. So how do we protect our buyers, but also put them in a position to be able to purchase the home if they really are a 10 out of 10? And so if the appraisal comes in low, we need to have strategies and solutions ready. First of all, talk to the borrower up front and be very clear with the fact that this is a possibility, and do they have the cash to be able to gap it. If they don't, okay, then we need to come up with other potential solutions. They can walk away, obviously, but let's talk about some other things. First of all, a lot of lenders might do a reconsideration of value, but do they actually know how to read an appraisal report? Do they know how to be able to find comps? Okay, so a lot of times I'll ask other realtors, or I'll look at loan officers, and they find properties that are a mile and a half away. Okay, they were sold, over 6 months ago. The one home is remodeled, the other one isn't, or has a lot of features the other one doesn't. And so that just, if you submit that to try to get a reconsideration of value, the appraiser is not even going to give you the time of day. And sometimes the appraiser did do a good job, but I've found that when things get, rates fall and there's a lot of homes moving, appraisers get busy. Like everything in life, there's better realtors than others, there's better appraisers than others, and there's better loan officers than others. And so finding the right types of properties to be able to compare them to, properties that are, within a half mile or less. If you have to go above that, fine, but we try to find the ones that are within a half mile, that have sold within the last 3 to 6 months, that are as similar as possible. And if they aren't, maybe have a few differences, a pool versus no pool, an extra half bathroom, those things, that's not the difference in the price. That you can obviously see that potentially this appraiser should be able to, look at this and maybe give yourself a little bit more value than what they started off with. And if you present a case to them, it's not only the appraiser that has to look at this, but the appraisal management company that we order these appraisals through, their head appraisal person will also look at this and see, hey, Trevor put together a lot of good points here. You need to consider these properties, and here's why. And I have gotten appraisals raised. Another option is reallocating the down payment. Okay, everybody, a lot of people might come in with 20%. That's what they think they need to come in with. But perhaps we could do 10% down. We use the other 10% to cover the appraisal gap, plus pay off the mortgage insurance. So you can buy out of mortgage insurance with the lender, or we could buy down the rate, so that at the end of the day, the cash out of pocket to the actual buyer is not that much different. It's almost very similar, but we're utilizing the extra cash to gap the appraisal and then to buy out of MI and buy down the rate. Now, look, if the appraisal comes in super low, then what we should also do is go and renegotiate with the sellers and say, hey, we got the appraisal. We've tried to do a reconsideration of value. We weren't able to find anything. I think this appraisal number is pretty, strong. If another person comes in here, most likely they're going to get a value around the same amount. Would you be willing to, come down a little bit? Would you be willing to go halfway, 50%, whatever number that we need to try to make the numbers work for the buyer to get it as close as possible to the payment that they originally had with their 20% down? And there's lots of different ways to be able to do this. I had this happen with one of my buyers. The realtor was actually his brother. He's a very green realtor. He put in an offer, 50,000 over asking when the market was super hot. We had the appraisal, it came in very low. I talked to the seller, who was also the person that was a fix and flip. And, he was very adamant about that he thought it was valued at that property, was valued at the amount needed. We had a conversation back and forth, and I just asked him, and I'll do this for my buyers, I'll do this from a real estate agent so I can be a second voice for you. I just said, hey, if we do another appraisal and that one also comes in lower, will you split the difference? And I'd already talked to my buyer. They were fine with that. And he said, yes. So yes, my buyer had to come out of pocket with another $500 for another appraisal. However, they knew that the appraisal came in lower, that we would be able to get the seller to come down on their price. Okay, so there's other ways to be able to do it. Everybody gives a little. The buyer comes in with some money. Maybe the realtors throw in a little bit. I try to do what I can with lender credits to make the deal work. Whatever it is, we always try our best to come up with a solution. Okay, and as a broker, I work with lenders that do complete pre-underwriting, fully approved outside of the property, title, and appraisal. Okay, this is not a DU approval. I know there's the automated desktop underwriting. Those can be wildly inaccurate only because it's going off of what the loan officer puts into the system. And being vice president of a loan company that had 400 loan officers, I saw loan officers that never even looked at the applications. They just went off of what the borrower put in there, and they ran, automatic desktop underwriting. So you don't really know, unless you're working with somebody that actually 100% knows what they're doing, if just a DU approval is good or not. So with this, you can get fully underwritten loans that are looked at and fully approved for the amount by a real underwriter. And so then you can go out there with confidence, knowing that, if they wanted to, they could write a offer with no loan contingencies if it met within the requirements that they're approved for. Now, the requirements for me to work with somebody that wants to do this, a fully underwritten loan, is they need to be prepared to make offers in the next 60 days. They need to be ready to provide all the documentation full for underwriting approval. I'm not here to chase down their documents. If they're serious about getting out there and buying a home, then they should be serious about being able to compile the documents needed. In a lot of cases, it's really not that much information. It can seem like a lot when we give a list, but most of this stuff these days with technology, you can compile in a weekend. And then commitment to us as a lender. So if you're going to refer somebody over to us for a fully underwritten approval, that, I would do the same thing for you, which is if somebody said, hey, who's the realtor that I should use in the San Diego area, I would say, if I were out there purchasing a home right now, the realtor that I would use would be, and then I would say your name, as long as if I'm partnering with you, then I believe that you're a great realtor. Okay, so that's just what we ask if we're going to do a fully underwritten approval. If not, even us as loan officers are very good at calculating income and can give you a really good idea, be able to get the pre-approval letter out to you. What we also do is we go above and beyond with credit. We do credit coaching because it's really important to the rate that your borrower is going to qualify for. The rate impacts the payment. The payment impacts your debt to income ratio, which inevitably impacts their buying power. You'd be very surprised how few loan officers go over the credit report with the buyer. Number one, are there any inaccuracies on there, especially with somebody that has a very common name or is a junior or second or third in their family? A lot of things can be wrong on a credit report. Okay, so we need to look at it for accuracy. Also, another thing is a lot of people pay off credit cards monthly. Okay, but what they don't know is they are paying usually by the due date of the when they have to pay the credit card company versus when the statement ends. Okay, so usually the due date's like 15 days after the statement ends. And if you pay on that date, then the credit card company still has the actual balance on the card and the minimum payment due because of the fact that the statement ended with that balance. So if your borrower is out there and they're going to be purchasing a home in the next 30, 60, 90 days, I tell them, hey, stop paying the credit card off when it's actually due and start paying the actual card off 3 days before the ending statement date. So if you look at any credit card statement, it says, this is through July 1st through, July 31st or whatever the day is, and you want to pay it 3 days before that last day so that when they report it, it shows a zero balance. Would it make more sense to pay off debts, raise the score, and put less money down? So let's say they have 20% or 15%, but they have $10,000 in credit card debt. Okay, that's sitting at 19%. It may make more sense not to put 20% down and instead take $10,000 of that money, pay that card off, and we can remove, a $200 minimum payment, $250 minimum payment, which if they're only making minimum payments, they're paying a ton of interest. And now that credit card is reporting at zero, which is going to increase their credit score. And then it's going to increase their buying power because we no longer have that debt on the report. Rapid rescores. This is a process of us being able to use a AI system that basically tells us what likelihood we can raise somebody's score and how many points that we can raise it. And I have another video on this if you want to get a little bit more into the weeds, or you can always set up a call with me and I can explain it to you. But essentially, when we pull somebody's credit score, we get the 3 credit scores, and then underneath that, it might say plus 20, plus 50, plus 100. If you click on those, it tells us with precision what steps that borrower would need to do to be able to get that point increase. Then we can give those directions to the borrower, and if they take those steps and then provide us documentation, we can submit it and update the score, not 30 days from now. It's within a few days, a few business days, we can raise somebody's score. Now, what if somebody has little or no credit history? Well, there's different things that they can do. If they're currently renting, they can report their rent. There's other things that they can report that maybe isn't currently reporting on their credit report. And then in this market, we all know that a lot of family members, they're trying to help out loved ones to be able to purchase a home because they know how expensive it is. I'm seeing a lot of gifted money to buyers, which is great. Okay. Family members wanting to help out is awesome. But one way that they can help out besides just giving money is if they have stellar credit, they most likely have credit cards that have a long history of being paid on time. And if they do, they could add them as an authorized user on that card, and all of a sudden your buyer now has all that history of that credit card. So let's just say that their parents have had the same credit card for 5-10 years. They've always paid it on time. They always pay it off down to zero. They get added on. They're going to get that 5 years of credit history added on. It's going to spike their credit score up immediately. And they don't even have to give them a credit card. They're just an authorized user, so they can't go out there and rack up money and different things like that. Obviously, both people need to trust each other, but this is also something that we should at least bring up because you never know whose family member would be willing to do that for them to help them out to be able to get them into that house. Okay, so we're going to give them a lot of tips on how to improve their credit score fast, which inevitably will help them get into a lower rate. If they have a lower rate, they have a lower payment, that they might be more comfortable going out there and purchasing that home. So if you let them speak with us, congratulations, your buyers just became significantly more competitive and more confident. You can offer confidently up to the max purchase price. They can compete with cash offers because they can get fully pre-approved. Okay. You can confidently remove loan contingencies because they've been through underwriting. You have an informed strategy. If appraisals come in low, we have solutions for that. As long as we communicate and the borrower is willing to give us, what their short-term and long-term goals are, and we can all be on the same page, then we can make sure that this is a great experience for everyone. And at the end of the day, when they purchase that home and we, reach back out to them 6 months, a year from now, 2 years from now, that they are still in love with their home. They're not regretting that decision. In fact, they're so happy with, what we did for them, that we're not just helping them, we're helping their friends, their family. And whenever they do decide to move up or to the next house, that they're coming back to you to be able to list that house with you because they remember the experience that they had. And we all know when we go to Amazon or anywhere else, we don't want to buy a 4-star toothbrush. We don't want, to work with somebody that's 4-star. We want to work with somebody that provides 5-star treatment. And so you can look me up. Not here to brag about the reviews or anything like that. I'm just showing you with the consistency that we provide to the clients and all the support that we provide them, we can get these 5-star reviews. And it's not only for us. When I get them, I make sure that they're reaching out and that they're getting you a 5-star review as well, because I know that it's only going to help us bring in more business when somebody researches us and sees how many clients are willing to write us a positive review. So if you want to learn more about making sure that your buyers are in a position that we can put them, like I said, a bulletproof buyer, that you're not wasting time out there with people that may not be ready to pull the trigger, that we can, overcome a lot of those fears at the beginning versus, you going out there, they're looking at homes and then all of a sudden it's a sticker shock when they're starting to put in offers. Then schedule a one-on-one with me. You can go to lendingagentshelp.com. You can also just text me at 619-404-6637. We can set up a time, or you can email me at trevor@harborfunding.group. And if you go to lendingagentshelp.com, you can sign up for a free account. We have a lot more trainings on there, and you can sign up for a weekly training where you can come live to be able to ask questions. I hope this is helpful to you. Regardless if you want to, send your clients over to us to be able to help them up with their loans, I hope this at least gave you a few tips and strategies for you to be able to grow your business and be able to give a 5-star experience to your next buyers.